Hi, everyone. Hi, Austin, Eric, Seth. Can you guys hear me okay?
Yes.
Okay, thanks, Austin. Austin, could you put yourself on mute for now?
Yeah, I'm trying to figure that out.
Okay, cool beans. Take your time. We'll get started in a few minutes. I'm going to put myself on mute.
Okay.
I'll be right back. Okay, guys. Looks like it's about 1:02, so I think we're going to get started. If anybody else joins us, great. Remember, we are recording this, so if you wanted to come back to this later, you can access it. I put it out on YouTube so that it's very easy to access from anywhere. What's nice about this Zoom is that it saves in a MP4 file, so it's very easy to put it on YouTube. Okay, so as I stated in my email, today's objective is to complete Chapter 3's homework review, take any kind of questions you may have, and then look at Chapter 4. We're going to focus on how we're changing the balance sheet. It is really cool, Austin, to do this. And we're going to also show you how we finish up the accounting cycle. So as we said the other day, we've added more to our accounting cycle, all the steps that need to be performed in a year where we found those missing revenues and expenses and got them properly recorded. That was our focus of Chapter 3. Chapter 4 is finishing up the accounting cycle. And remind me, in case I forget, on Tuesday, but now you'll be able to work on that project that's due at the end of the semester. It's really at the end of Chapter 4, so it might be time for, if you have some time between, a little extra, you will be able to work on that now and get it done. Okay, so I'm going to go to page 171 of the book. I'm going to open up my file and then I'll share the screen with you so you can see the answer key. Where am I here? Okay. So we're looking at P3-35A. And it's just taking a little bit to open up. Okay, and I'm going to come back over. my Zoom room and share my screen so that you see chapter 3. So if you don't see that, please send me a chat and let me know. But let's scroll on down. Sorry if it's making you dizzy. To P335A. Went too far. We'll get there. Okay, that was 36 from the other day. Okay. So in P335A, we have Anniston Air Purification Systems, and presented there is their unadjusted trial balance. So remember when we were talking about the accounting cycle? The accounting cycle is what we are involved in now. We've done the first steps in the accounting cycle actually in chapter 2, and that is record your everyday business transactions and post them to the T accounts. And it's at the point where the company has to make a financial statement, and that is one of the steps in the accounting cycle. All the things that have to happen in a 1-year period, the accounting year. And a company must make a financial statement once a year. Sometimes they'll do it more than once, but they must do it at least once a year. So we're operating under the assumption that the companies we're working on only makes a financial statement once a year. So when they're saying we've got to make a financial statement, now's the time they first want to make sure currently in their T accounts, all their debits equal credits. So that's really why we make an unadjusted trial balance. As of right now, is everything copacetic? Is everything equaling? So the information on page 171 is really out of Anniston's general ledger. Now there's a little more information in my answer key, but take a look. So here are the T accounts for Anniston. Take a look. Cash has a balance of $7,600. So when you created these T accounts, that's your starting point because that is a balance right now. They're unadjusted trial balance amounts, $19,700. You see that right there. So you should have created T accounts with the balances from that unadjusted trial balance, and even create a T account for an item that doesn't have a balance in it, because it means you're going to use it. So that was the first thing you should have done. Now, what's our next step in the accounting cycle? Well, now it's time for us, since we're going to do a financial statement, to make sure all the revenues that have been earned are recorded and all the expenses that have occurred this accounting year have also been properly recorded. And it's at this point we can't confirm that everything is. So we have to ask ourselves that. And what's nice is in the real world, we kind of search for that as accountants, but in your book, they're going to give you some information there to say, hey, here's some data. You might want to use this to see if there is anything missing and you need to get it recorded. So when we look at this data, we have to ask ourselves, was there a revenue earned missing or an expense that occurred missing? And if your answer is yes, you must make a journal entry for it because it should have been recorded. And these journal entries that occur during this process, we call adjusting journal entries. Now, we're not used to the presentation technique your author gives. We're used to looking, whoever just came in, just put yourself on mute, okay? We are looking at the company, or I'm sorry, I lost my train of thought. We are looking at transactions usually from chapter 2, we're like, paid utility bill with cash. So it's very obvious now when you look at it, you'll be like, oh, okay, utility expense and cash were affected. It's not so obvious with these types of pieces of data. So they're not giving you a transaction, they're giving you a piece of data. So let's start and take a look. Here's an adjustment data at December 31st. On December 15th, Aniston contracted to perform services for a client, and they received $3,100 in advance. On that day, so this was a couple days ago, 2 weeks ago, Aniston recorded this receipt as a debit to cash and a credit to unearned revenue. And if you look in that T account you created for unearned revenue, there is a credit balance in it of $3,100. So it's recorded, it's there. Our question is, at December 31st, do we need to do anything with regards to that unearned revenue? So let's see what the data says. As of December 31st, Aniston has completed $2,100 of the services related to that payment. So what's the adjusting journal entry? Whoops, that results. Let me go back over here. Come on. I can't move. Let me see. There we go. And there it is. On December 31st, our adjusting journal entry is increased service revenue for $2,100. We've earned $2,100 of that $3,100 payment we received a couple weeks ago. The day we received that payment, we couldn't call it service revenue. We hadn't done anything yet. So we credited the liability account unearned revenue. Well, now when we perform the service or that portion of it, debit the liability unearned revenue. We've done that. We don't owe it anymore. Credit service revenue. So that we increase service revenue to reflect that's how much we've earned by December 31st. Okay, so if I'll check every so often to see if you guys are asking any questions, or if you want to unmute yourself to ask a question, you're more than welcome to. But if you're not stopping me, I'm just going to keep going. All right. In Part B, Aniston prepaid 2 months worth of rent on December 1st. And it goes on to tell us, assume the prepaid rent balance. So up in that unadjusted trial balance, and also in your T account, prepaid rent, there's a debit balance of $2,900. Assume that is representing that 2 months of rent they paid for early. Paid it December 1st, but aren't receiving the service till December and January. So what do we do with that? Well, the question is, did any of that become an expense by December 31st? And you should have answered yes. We've received a month's worth of rent. So we should expense half of that. Debit rent expense, $1,450, credit the asset prepaid rent because it is not owed to us anymore. Remember, the day we paid that early, we debited the asset prepaid rent. That was owed to us by December 31st. Half of it has expired. We've received that service. Show that portion as rent expense. Decrease the asset prepaid rent. In Part C, I'll check sometimes I get notification if somebody puts a chat in, sometimes I don't, so I always double check. Aniston used $750 of the office supplies. Now, if you've noticed here in this problem, compared to the one we did on Zoom the other day they told us how much office supplies were left in the closet. Here they're telling us straight out, they've used $750 of their office supplies. So they're telling us how much to expense of the office supplies. The other day we had to figure that dollar amount out. So there's two different ways these could be presented, and that's the tricky part of this chapter as well. So you want to debit supplies expense for the $750, credit the asset office supplies for the $750. In the next D, depreciation for the equipment is $850. Let's just step back and review depreciation, because people get caught up on this a little bit, because we try to look and assimilate to something outside in our real world. And we hear that word depreciation, and a lot of people think decrease in value. My car depreciates $1,000, 10% when I drive it off the lot. Well, that's true in the real world. But in accounting, in our world here, depreciation is the expensing. So you're going to be debiting an expense account. What are you expensing? The cost of what we call property, plant, and equipment. Property, plant, and equipment are assets we use more than a year that are tangible, and we use them in our company. Things like building, office equipment, furniture, vehicles. We don't include land because we don't depreciate or expense land. Because the other key component of this is that it's the assets that will deteriorate over time that we expense because we use them up, where land does not deteriorate. Now, you won't calculate depreciation amounts yet, so they just come out and tell you the amount. What you need to know is how to record it. So we will definitely debit depreciation expense equipment, $850. So that part of the asset's cost is being expensed. We don't credit the equipment account directly. Instead, we use a special asset account. It's a contra asset, and it's called accumulated depreciation equipment. Now, you're going to see various contra accounts as we continue through the semester. This is an asset contra account. An contra account always has a buddy account. So it always has an account that it's storing information about. So a contra account can never just be sitting on a trial balance or in the general ledger by itself without having a buddy. And we store information about its buddy in there. So the accumulated depreciation equipment account's buddy is equipment, because we're storing the amount we've expensed of the equipment in that account. Also, contra accounts always increase on the opposite side of its buddy. So since this is an asset account and it's a contra asset, it will always increase on the credit side. Now, fortunately, there's not like a contra account every chapter. This is our first one. We might have another one in chapter 5. Every so often you'll see one, but you need to remember what it's doing, okay? Are there any questions on that? Because I know that's a totally new kind of crazy thing. Okay, then I'm going to go to the next. So BTW, remember, we could put adjusting journal entries into categories. So far, A, that is our unearned revenue adjusting journal entry. B and C are prepaid expense journal entries. And now we've just done the depreciation adjusting journal entry. So we'll see if we can get 2 more, the last 2, get some experience with them. And we will in letter E. Aniston received a bill for December's online advertising. Great. It will not pay the bill until January. So on December 31st, they got their bill. They received advertising service during December. The question is, do we do anything? Absolutely. This is an expense that's happened. Debit advertising expense, credit accounts payable. So we increase the advertising expense T account and we increase accounts payable. We're not paying it today. We're not paying it till January. But we don't record expenses when we pay them. We record expenses when we received the service. This is an accrued expense. Remember, it's an expense that has happened, and it should be called an expense, but it isn't recorded yet anywhere, and it's not paid for. We'll get it recorded, and that's what we just did. In letter F, that's another example of an accrued expense. Aniston pays its employees on Monday for the previous week's wages. Its employees earned $3,500 for a 5-day work week. December 31st falls on Wednesday this year. Okay, so December 29th, the Monday of that week, all the wages were paid through the end of the prior week. So the question here is any of this week's wages that have been earned by our employees, should they be expensed? And the answer is yes. The company's employees worked Monday, Tuesday, and Wednesday in 2018. The wages related to those 3 days should be an expense by December 31st, 2018. Sorry, excuse me 1 second. Okay, so we should debit salaries expense and credit salaries payable. Now, where did the $2,100 come from? $3,500 is the total for 5 days. So if you take $3,500 divided by 5, per day it's $700. How many days happened in 2018 that are not recorded yet as salaries expense? 3, Monday, Tuesday, and Wednesday. So 3 times 700, there's your $2,100. I'm not seeing any chat. I'm just going to flip over here really quick. Oh, sometimes, oh, there we go. Okay, cool. All right, so now let's go to the last one, which is really our demonstration of an accrued revenue. Now, the other day when we worked on our practice problem in class, we didn't have an accrued revenue journal entry. We talked about them, but we didn't get to experience one in that problem. Now we will. On October 1st of 2018, Aniston agreed to provide a 4-month air system check, and they started it in October. And the total they're going to charge the customer for those 4 months is $3,400. Sorry about that. Aniston has completed the system check every month. So they've performed the service in October, November, and December. But payment has not been received, so they haven't gotten any money from the customer yet, and they haven't made any journal entries related to that. So the question is any of that revenue? And the answer is yes, 3 months worth. So $3,400 divided by 4, that's $850 a month is earned revenue. So 25 times 3 months, $2,550 should be recognized as revenue by December 31st. We've earned it. We haven't received any cash yet from the customer, and we've made no journal entries related to this. So now we have to credit service revenue to show you've earned service revenue, and then debit accounts receivable. The customer owes you that money. Okay, so those are some great journal entries between that and P336. If you do those and you can get through that graded assignment, you'll be in great shape. Just so you know, on the next test, I will only test you on journal entries. We go through the whole process so you can see the whole accounting cycle of posting and creating an adjusted trial balance. But for testing purposes, I focus on the journal entries now. And we'll talk more about that on Tuesday. Any questions at all? Okay, guys. Well, then our next step, if you think back to our discussion on Tuesday, is we've got to post each of these journal entries to the general ledger T accounts affected and update the balances for these missing items. So you have your journal entries in front of you, and I'm just going to show you in the answer key. So for A, journal entry A, trying to get back over to my, there we go. You should have debited unearned revenue, there it is right here, and credited service revenue. Decrease under, well, whatever happens in your journal entry, we've already done the analysis, you do in the T account. For B, on the debit side of rent expense, $1,450. On the credit side of prepaid rents, $1,450. In C, there it is. On the debit side of supplies expense, $750. On the credit side of the supplies account, $750. In D, debit side of depreciation expense, equipment, credit, let me collapse the ribbon here so you can see it. On the credit side of accumulated depreciation, $850. In letter E, debit side of advertising expense, $1,100. Credit side of accounts payable, $1,100. In F, debit side of salaries expense, $2,100. Credit side of salaries payable, $2,100. And then our final adjusting journal entry, on the debit side of accounts receivable, $2,550. And on the credit side of service revenue, $2,550. Okay, so we just posted all of those adjusting journal entries. And if you think back when I started talking about the general ledger is the center of our accounting system. It's our mothership. And the only way you can change a balance in a T account is through a journal entry. Journal entries increase and decrease the balances in those accounts. So it doesn't matter what the reason is that you are doing journal entries, you must always make sure they get into the respective T account it's affecting. Once we do that, then the next step is find updated, or what we call adjusted balances of each account. So the cash account still has a balance of $7,600. That doesn't go away. But accounts receivables balance went from $19,700 and we added $2,550. So its adjusted balance, $22,250. Prepaid rent, that's adjusted balance is $1,450. Remember, we decreased it. Office supplies, same deal. We decreased that $750, so its new balance is $1,050. The equipment account doesn't change during this process, so that's its adjusted balance. But accumulated depreciation equipment does change. It increases to $4,750. Accounts payable increases to $4,000. Salaries payable didn't have anything in it before our adjusting journal entries. It now has a balance of $2,100. Unearned revenue decreased, now has a balance of $1,000. Common stock and dividends, they don't change. They usually don't during adjusting journal entries. Look at that service revenue. If we didn't do adjusting journal entries, it would look like we only had $15,300 of revenue, when in fact we have $19,950. See how we're updating and getting those balances perfect. Salaries expense. If we didn't do an adjusting journal entry, we would have been off on our salaries expense. It's at $5,400 now. We wouldn't have even had rent expense recorded. Now we have a balance of $1,450. Or depreciation expense on the equipment. Advertising expense increased to $2,900 debit balance, and then supplies expense increased to $750. So you can see how these special adjusting journal entries really get our accounts fine-tuned, gets all that revenue and expense that was missing. And it's not because we did something wrong, it's just because of the nature of the item. Now it's recorded. And these are common. Like I said, usually at the end of the year, we could fit an adjusting journal entry into one of 5 categories, the ones presented here. It doesn't mean either that you always have to have one in each category. It just means they could typically fall into one of these categories. I've worked at companies where I've had 10 accrued expenses at the end of the month and no unearned revenue because we never had our customers pay us before we performed the service for them. So it just depends on the company. Any questions? Come on, where's my, there we go. All right. So then our next step if you remember, and hopefully you have this done, is to now create our second trial balance, which is called the adjusted trial balance. So there's Aniston Air Purification Systems adjusted trial balance as of December 31st. A trial balance is a trial balance. All a trial balance does is list each account with its most current balance in the T account. So we're just listing those updated balances from each T account we just did in the proper order: assets, liabilities, common stock, dividends, revenue, expenses, and making sure that the debits equal the credits. Okay, so I'll give you a few seconds there if you're jotting anything down, or if you have any questions. Just so you know, requirement 4 is also there, and I answered it just now. Actually, I answered part of it because we do this trial balance to prove debits equal credits, of course, but more importantly, this is the trial balance we use to create our financial statements. And we started to do that for P336A the other day while we were working on it. And we're going to come back to that problem in a few seconds. So go ahead, I'm going to unmute myself, I think, or mute myself. I'll mute myself and give you a minute or two, and then if you have any questions, please let me know. Essentially, I'm done with chapter 3. And your graded assignment, all the due dates are going to remain the same. So it'll be due Monday night. But if there are any more questions on Tuesday's class, I think I'm going to run through this whole thing again on Tuesday, just so that we're all on the same page with everything, because some people can make this and some people can't, okay? So I'm going to mute. I'm back. Okay, while you're wrapping that up, anybody who's ready to roll, you want to get your P3-36A problem back out. I don't have the T accounts. I can't create them and change them on the computer. Okay, I guess I can create them on the computer in Excel or something, but it's easier if you just have them in front of you, and then we could talk about the changes and you can update your own while they're in front of you. So that was the P3-36A. And you also want to get your notebooks out because we're going to continue working on the financial statements. I think actually we have to even start them. That was part of the homework I asked you to do, the income statement and statement of retained earnings for Guthrie & Company. Okay, I'm going to stop sharing my screen a second so that I can get my files. And then we'll share a screen again and trying to think where I put them. Bear with me a second. There we go. Okay, so I'm waiting for Excel to open. I'll give you a play-by-play here. As soon as this opens, I'll share the screen. So if you could get to page 172, and I'm going to share the screen now to my Excel. Okay, so there is Guthrie & Company. Now, our The other day, for those of you who weren't here, and you need to listen to that first recording we did. I posted it out, I think, on an announcement, or I emailed you with the YouTube video. We ran through the entire process here of creating, creating the adjusting journal entries for Guthrie in, posting those to the T accounts, finding new balances, and coming up with this adjusted trial balance figure. And if you give me one more second, I'm going to grab my notes from the other day. So if you see a bunch of crazy stuff, sorry about that. There we go. And I'm going to just share my notes. Could you all see my Word notes in front of you right now? Come on. If you can't, just do something in chat. Just say, no, I can't. I'll give you a second. No. Good. Okay. I got to tell it to share it. There we go. Can you see it now? Let me see. Come on, bring my chat up. If you have audio, I don't know, it's not showing me any chat stuff. Just saying I have no chat. So if you're telling me no, I can't see or hear you. If you have audio and you want to yell no. Okay, so that means you see it.
We're good. We're good. They said yes.
Okay, thank you. I just can't see the chat for whatever reason. So good. Thank you, Austin. Okay, so these were the notes we were working with the other day, and the accounting cycle. And you would see those in that presentation. And here's where we ended, created an adjusted trial balance. Now it's time to create the financial statements. So I'm going to be flipping back and forth here from Excel to Word. So if any time there's any issues with seeing stuff, just interrupt me. But I will make sure that I properly share. So I'm going to go ahead back over. That's not what I wanted. Yeah, that's the one I wanted. To my Guthrie in adjusted trial balance. And I'm going to create a, actually I could probably do my income statement. No, I better start a new one. I'm going to create an income statement and statement of retained earnings from the information on the adjusted, on the adjusted trial balance. You should have this done, but if you don't, Guthrie in company, income statement's an income statement. And I'm going to assume, if you put month ended, that's okay, but I'm going to assume this is for the year ended December 31st, 2018. I'm going to start with my revenues, just as I always do, specifically service revenue. So I'm going to have to flip back over to my other sheet and find my service revenue. And there it is right there. It's an updated balance of $17,500. Remember, the only other items that go on an income statement are the expenses. I'm going to come back over to my adjusted trial balance, and I'm going to cheat a little, and I'm going to copy and paste my expenses. And then I'm going to add my expenses up. And label total expenses. I will then subtract the expenses from the revenue, double underline my result, and because it's positive, revenues are more than expenses, label it net income. Guthrie made a profit. Any questions? Okay, let's go to the statement of retained earnings. Again, let me format my sheet. Got 3N Company, statement of retained earnings. Again, this is for a period of time, year ended December 31st, 2018. Now remember, on this statement, we're reporting how retained earnings changed during a period of time. And the three things that could change retained earnings are revenues, expenses, and dividends. So we're going to say retained earnings starts on 1/1 with 0. After this chapter, well, actually, after we get into chapter 4, you'll see why there would be a beginning balance or an amount as of 1/1. But for now, so we're going to actually be adding a new T account called retained earnings in chapter 4, but one step at a time. We're going to add the net income for the year because revenues and expenses change retained earnings, but you don't have to rewrite all the revenues and expenses. Since we already wrote all the revenues and expenses and found an overall positive or negative result from those two items, this is a positive result, we'll add it. So net income increases retained earnings. And then we'll subtract any dividends. I'm going to come back over to my spreadsheet. This company had dividends of $23.40. So I'll subtract the $23.40 from my $7,600. The final balance of retained earnings on December 31st, 2018, $5,260. Okay, so those didn't change. They're the same financial statements we learned back in chapter 1. What I'm going to do now, why won't that come up for me? There we go. Okay, put that over there. Maybe it'll stay there for me. Now we're going to do a balance sheet. Okay, I'm going to go back over and share my lecture notes. And we're going to write some stuff down about the balance sheet. First of all, in the real world, we don't do a balance sheet the way we've been doing it in chapters 1 and 2. We kind of do, but we get a little bit more detailed. Our balance sheet is now going to be classified. Now, classified doesn't mean top secret. It's a word we use to describe categorizing items on our balance sheet. So what we're doing is categorizing or classifying assets and liabilities between two types. They're either going to be current or long term. And this is getting into our chapter 4's lecture now. Okay, that's the first thing. The format of the balance sheet can also be done in one of two ways. When we say format, we just mean what it looks like, the template we use. What we have been using is called an account format. Assets on the left side, liabilities and equity on the right side. It looks like an account. Assets on one side, liabilities and equity on the other. The other type of format is called a report format. And that's where you list assets and then right under assets, not next to them, right under it, liabilities, and then underneath the liabilities, stockholders' equity. So if you go to, let me find the page number. Come on. Go to page 190 of your book. You will see a report format balance sheet. Now, we could have done a report format balance sheet in chapters 1 and 2 and 3. Your author waits till now to talk about it. So we've done an account format. They're both correct. You pick which one you like better. Well, for chapter 4, I pick. So since we have a new format, we're going to complete our balance sheet in that format, similar to what we see on page 190. Whether you do an account format or a report format, you will always classify the assets between current or long-term. So let's get into that now. Let's first make sure we understand what a current asset is. So in your or on your adjusted trial balance, you're not going to have the words current assets. What you're going to do is look at your adjusted trial balance and say, what are the assets? And then you're going to ask yourselves, which assets? So it's an asset, that will be used up by the end of the next accounting year. So you're going to use it all up, or you're going to collect it within the next accounting year. Okay, the typical types of current assets: cash, accounts receivable, prepaid expenses. So it could be insurance, prepaid rent, prepaid insurance, and then the other are supplies. So these are the beginning of our current assets. We'll add to this list. And they have to be listed in this order on the balance sheet, because we list current assets in financial liquidity order. And what this means is the quicker an asset can be converted to cash, the more financially liquid the asset is. So we've got to kind of rank them. Cash can't get any more like cash, can it? It's already in that form, so that's why it's always listed first. Usually accounts receivable is the next asset in financially liquid assets, meaning it can be converted pretty quickly to cash, more quickly than prepaid expenses or supplies. Prepaid expenses and supplies are generally on the same financial liquidity field. So it doesn't matter if you put supplies then prepaid expense or prepaid expense and then supplies, because really in the end they are all prepaid expenses. Prepaid expense and supplies are prepaid expenses. Okay, so that's how we do current assets. So I'm going to come back over and we're going to do the current assets on the balance sheet for Guthrie. Now, we're going to do this in report format. So I think you could see my grid lines here. I'm going to have one big column, and then I'm going to have, let me see, for this one, I think I only need two other columns for numbers, like a debit and credit column. It looks like it's not, but that's what it looks like. So if you're drawing this in your notebook. Okay, so our financial statement always starts with the name of the company. Balance sheet. You don't put classified balance sheet. That's just what we use to describe how we do it, because it's classified now between current and long-term assets and liabilities, and then it's still going to be the date. That doesn't change. Okay, so the first items we list are going to be the assets. That doesn't change either. So I'm going to label my columns assets. But now my first type of asset will be current assets. So you got to label those. And then I'm going to come back over to my trial balance. and say, okay, what were the current assets? Well, there's cash, accounts receivable, prepaid insurance, and office supplies. So those are my 4. Okay, so I list them with their dollar amounts. I'm going to add them up and put the total out of my column to the right. B6 to B9. And I'm going to label exactly what that is. Total current assets. How are we doing? Any questions? Okay. Now I'm going to go back over to my notes. And let's talk about long-term assets. If a current asset is an asset that will be used up by the end of next year, next accounting year, then a long-term asset is an asset that will not only be used during the next accounting year, but also beyond. Okay, so you're not going to use it all up in the next accounting year. Now, there are 3 subcategories of long-term assets. We're only going to learn one and deal with it today, but I want to make you familiar with the other one. So I'm going to first show you the one we're dealing with today, and it's called property, plant, and equipment. We've already dealt with this when we talked about depreciation. It's the same category. These are tangible assets that will be used in the company for more than 1 year. Buildings. Land is one. Equipment. Furniture. Vehicles. Those are your typical property, plant, and equipment assets. So we'll show you how we report those on the balance sheet in a second. But I just want to tell you about the other 2 categories. We're going to learn about them. It's just not going to be till a little later in the semester. The first one is called the investment category. And this is where we report assets that are not used in the operations of the business. So we own this asset, but we don't use it to produce income. It's not something we're physically using. Something like stock of another company. So if our company buys the stock ownership of another company, that's considered an investment. We're not using it to do our product or service day in and day out. We just kind of buy it and let it sit there and hope it goes up in value. Okay, so it's a different type of asset. And the other category of long-term asset are called intangible assets. Intangible assets are assets that lack physical form but are used in the business. They're more legal rights that you have to purchase. Things like patents, copyrights, trademarks. These are some common examples of intangible assets. So if you're not familiar with what a patent does, it's the legal rights given to whoever owns the patent, protects an invention the patent is for. So only the person who owns the patent can legally make and sell that product. Nobody else can steal that and become competitive with them. And they usually allow that for 17 years. Patents, I believe, are 17 or 20 years. Don't quote me on that, but it's around that time. And they're given out by the U.S. Patent Office. Copyrights, they protect something different. Copyrights are protection of artistic creations, books, books, art, paintings, things like that. That's what a copyright protects. So they last for the, songs, right? The life of the creator plus 70 years. So even after the person who has the copyright passes away or created the copyright, they pass away, 70 more years has to pass, and then the copyright is no longer in force. So then anybody could profit from that. And I always tell my students, I think of Elvis. Elvis died when I was about, I think I was 10 years old. I was just about 10 years old, and 8 or 9 or 10. And I still remember the day he died because we used to get the newspaper in the afternoon, and I was at my grandmother's and she got the afternoon newspaper. And I said, Gram, Elvis died. And she's like, oh my gosh. And now I think, because he has a daughter who's my age, maybe a year older than me, but 40 years has passed. And in 30 more years, his copyrighted stuff out there will no longer have a copyright, so anyone can profit from it. I don't know if I'll be alive when that happens, but it'd be interesting to see what does happen. Trademarks protect symbol, slogan. Okay, so if you have any Under Armour on right now, that little UU, upside down U, Under Armour, that is protected by a trademark. Only the company that owns the trademark can profit from that symbol legally. Okay, so just some information about those items, get you familiar with them. You won't have those types of assets yet on the balance sheet, but we will in the future. Are there any questions on those? Okay, then what I'd like to do is I'm going to go back over and share to my Excel, and we're going to complete the property, plant, and equipment section of the balance sheet. So here I go. Okay. All right. Now, I'm going to go ahead over to the trial balance. The only other asset this company has, definitely property, plant, and equipment. It's a building. But watch what happens. We're going to come over and we're going to put our label property, plant, and equipment. And then we're going to put the building. And we're going to put the building, report that on the balance sheet at its amount it's currently in that account, which is the cost of that building. Now here's where you see the magic of a contra account. Remember, anytime we record depreciation, expense that building, we don't credit the building account directly. I'll come back over. We credited this contra account, and it has a credit balance in it. Well, now we're going to subtract that credit balance. When we report the building on the balance sheet. And since there's only one asset in this category, we'll do that and put the total out in the right column. So 530,000 minus 261,200. So the total property, plant, and equipment, 268,800. We are now done reporting the assets. So we're going to add the total current assets to the total balance of property, plant, and equipment. Double underline, label it, total assets. So we're still reporting the assets, it's just that we are better defining them by the category they fall into. And if you say, I like the other way better, well, so do I. But you know what? That doesn't give as much information to decision makers as this does. And as we go through the semester, it'll make more and more sense why we do our balance sheet this way. Okay, so I'll give you a second to get that together. And then we're going to go back over to my Word doc. And let me see, I'll share that again. And now let's talk about current and long-term liabilities. So a current liability is a liability that is due by the end of the next accounting year. So it's due and you have to pay it off. Most of our liabilities, guys, are current. Most people don't want to wait more than a year for their money, right? So a long-term liability, of course, then is a liability that is due beyond 1 year or the next accounting cycle. Accounting cycle or year, it's always a year. So this one's pretty straightforward compared to the assets. Like I said, unless they tell us differently, the assumption is our liabilities are due within a year. So I'm going to go ahead over to my Excel again. And now we're doing our report form. So instead of putting liabilities and equity on the other side of the assets, we're going to put them right underneath. So first we're going to list liabilities, and that should be centered. And then the first are current liabilities. We always show the current ones first. Now, if you go to your trial balance, the only liabilities this company has are these three: accounts payable, salaries payable, and unearned revenue. And I can tell you, they're all current. The only liability that you will see that's long-term is a notes payable, a loan that is due beyond 1 year. And in Chapter 4, they'll tell you if it's long-term or not. Okay, so under our current liabilities, we're going to list each liability that is current, put the amount in that center column. And just like we did with our current assets, we're going to underline the last one, total them up, and then label them. So we've reported all of our liabilities, but let's pretend there was a notes payable. We're just going to say it's a zero balance. What we will do then is put long-term, liabilities, notes payable, 0, and then we would do an overall total liabilities. Whoops, this should say total current liabilities. Sorry about that. Getting ahead of myself there. So it should be total current liabilities when you total up just the current liabilities. Total liabilities would be current plus long-term liabilities. Okay, I'm not seeing any questions. If anybody has anything, please let me know. So you've just created, almost finished, a classified balance sheet, classifying assets and liabilities to whether they're current or long-term based on the definition of each. So now our last part is stockholders' equity. The good news is you just report stockholders' equity as you always have. What is the balance in common stock? Looking at your trial balance, $288,950. And then what is the balance of the other major portion of stockholders' equity? Retained earnings. And I'm just going to flip back. We figured that out on the statement of retained earnings, $52.60. So let's add those two together and label total stockholders equity. Almost done. Now we have to add together our total liabilities and our total stockholders equity and label it. Well, first let's underline that and double underline that total. Total liabilities and stockholders equity, and that equals total assets. Yay. Our financial statements are done for Guthrie & Company. Well, the financial statements we need to complete. Are there any questions? I'll give you a second to get that stuff done, and then we're going to show you the last step in the accounting cycle. Well, it's really a three-part process, but it's our last official step. No questions? Okay, guys. Well, I'm going to go back over to my Word document, do some more lecture notes because we want to finish up this accounting cycle. Come on. Okay. Once we are done with the financial statements for a year, for an accounting cycle, an accounting year, we've achieved our purpose for that year. We have been doing all the summarizing of our accounting information, of our transactions, into journal entries and the T accounts, and then we made sure those T accounts were perfect for the year by making sure all of our revenues and expenses were recorded with those adjusting journal entries, and we created our financial statements. That's the reason we're here. But at the end of the year, we don't rip up our general ledger and throw it away and go, let's start over next year. No, we continue using the one we currently have. So we need to clean up. We need to get our general ledger, those T accounts, ready for next year. Now, what do we have to do? Well, right now, we can classify, not to use that word too much today, but we could put our accounts into one of two categories. One is called temporary. Temporary accounts can only accumulate information in them for one accounting year. They then must be cleared out. So any balance in those accounts must be cleared out, and the account needs to be back to zero in order to start the next accounting year. We have three types of accounts that fall into this category: revenues, expenses, and dividends. So what this is saying is at the end of the accounting year, we must take those balances that we've accumulated for that entire year, all the revenues and all the expenses, clear them out, Make sure that account has a zero balance before we start the next accounting year. Why? Because we can only accumulate information in those accounts 1 year at a time. Well, if you remember a few minutes ago, I told you the only way to change an account balance is with the journal entry. So guess what? Our last steps, what we call the closing process or the cleaning up process, starts with what we call closing journal entries. And there are typically 4 closing journal entries we do. And I'm going to write down what they achieve, and then we'll show you them using Guthrie In. The first is we want to get reset revenues so that they have a zero balance after posting the closing journal entry. So that's what we do. We're creating a journal entry to reset revenues to have a zero balance after we post that journal entry. Maybe we'll do that one first. Now get your general ledger out for Guthrie, okay, because I'm going to have you post each of these closing journal entries as we go. So I'm going to go ahead back over, and here's Guthrie. Okay, now if you don't have your your general ledger in front of you, here are all the accounts that currently have a balance that are temporary. They need to have a zero balance. So the first thing we want to do is create a journal entry. So once we post it to service revenue, the account will have a zero balance. Currently has a credit balance of $17,500. Well, I'm going to come over to my journal entry sheets, and on 12/31/2018, closing journal entry 1, I'm going to debit the service revenue account for its entire balance. It's the only way I could get it reset to zero. If it has a credit balance of $17,500 and I debit it for $17,500, then the balance will be zero. Now, what account do I credit? It's a brand new account, so you're going to have to create this T account in your general ledger. And we only use it during this process. It's the only time you'll see it, and it's called the income summary. And you're going to credit that account for the same amount of money you debited service revenue for. So I'm going to create my income summary T account right now in my general ledger. And I'm going to post this to my T account. I'm going to debit service revenue, $17,500. Oh, and now is a zero balance. Hip, hip, hooray. And then I'm going to come over to this new account I just created, income summary, and credit it for $17,500. Okay, so that's your very first closing journal entry. On a test, I'm not going to say reset revenues to zero. No, these are very standard journal entries. Every company does the same ones. You need to know I need to do these 4 closing journal entries to accomplish the objective, which is to get the temporary accounts all reset to zero. So I'm going to go ahead back over to my lecture notes. Let's talk about the second journal entry. In the second one, we want to reset expenses so that they will have a zero balance after posting the closing journal entry, just like we just did. So now we have to create a journal entry so that after we post it, each expense, the balance will be cleared out, reset to zero. Okay, so if you're jotting that down, I'll give you a minute, and then we're going to go back over to our spreadsheet, or you could start trying to do it now for Guthrie. So I'm going to come back over and share my screen. All right, guys. So if you have your general ledger in front of you, you can see we have 1, 2, 3, 4, 5 expenses. Yep, 5 expenses. And we could show you the adjusted trial balance because these accounts all have balances in the general ledger still, and they're the same balance. So we want to create a journal entry so that each of these balances are 0. So I'm going to come over and I'm going to use 12/31/2018 CL2. Now, so you know, I know the income summary account is the account I will debit. Because how do I get all these or all these expense accounts that have debit balances to 0? I have to credit them. Salary expense will be credited for $38.80. It's balance. Insurance expense, we will credit that for its balance. Depreciation expense building, same thing, credited for its balance of $1,200. Advertising expense, credited for $620. And then supplies expense, credit that as well for the $300. We will debit that account we only use during this process, the income summary, for the total. So you just add them all up. Add up all of these amounts you credited, debit the income summary. Now that's just the journal entry. If you post these now to your general ledger T accounts, you'll see the magic. I'm going to debit the income summary account, $9,900. But then I'm going to credit each expense, $38.80 to salary expense. Now its balance is 0. I'm going to credit insurance expense, $3,900. Had a balance of $3,900, I just credited it for $3,900, 0 balance. Credit depreciation expense building, $1,200. Credit advertising expense, $620. And then credit the supplies expense, $300. So if you're doing this in your general ledger, you will physically see the revenue and expenses have now been reset to 0. There's no balance in them. Essentially, what we just did in these two journal entries is we moved all the revenues into this income summary account, and we also transferred all the expenses into the income summary account. So 2 down, 1 to go. Are there any questions right now? Okay, then I'm going to go ahead back over and share my notes. And let's see what the third journal entry is. The next journal entry is we reset the income summary account so that it will have a 0 balance after posting. And we do the opposite, to the retained earnings account. Whoa. So now we're going to create a T account for this thing called retained earnings. And I'm doing that right now next to my income summary account. So now any earnings from this year need to be put into the retained earnings account. And that's essentially what we're accomplishing here. So what I usually do is I find the balance in my income summary account right now. Let's see, there was a credit of $17,500 and a debit of $9,900. So right now, my income summary account has a $7,600 credit balance. I'm going to go ahead back over to our practice here. That should look familiar. That's what net income is. There's the credits in the income summary account. There's the debits. So the balance of the income summary account, and that's what it is, it's a place we summarize net income, should be your net income or your net loss. Well, we don't keep an account called income summary hanging around. No, we need to get rid of it. So how do we get rid of the income summary account that has a credit balance in it of $7,600? Debit it. So debit the income summary for $7,600. Credit retained earnings for the $7,600. And that's what you should do. That's where net income belongs. Okay. Now, if you're sitting there going, why didn't we just credit retained earnings in our first journal entry and debit retained earnings in our second journal entry? Wouldn't we have accomplished the same thing? The answer is yes. And I have been an advocate to do that because I think this income summary account causes more harm than it really needs to. Back in the days when we did manual accounting and actually did closing journal entries, this showed how we got our net income into its final resting place. Okay? But in the real world today, guys, we use computers. We hit a button. We click an option. And the software resets everything to zero and automatically shifts everything into the retained earnings account where it belongs. Okay? It's just that the transition from manual accounting to computer accounting hasn't been as quick in this area, and authors still love to use the income summary account to say, let's get all of our net income or net loss into one place before we send it off to retained earnings. And that's all that's accomplishing. Okay, so don't think about it too much. It's just what one accounting instructor said to me was an audit trail. And I said, you've never audited before in your life, have you? But that's what academia calls it. So who am I? We just got to follow the rules that are set and how your author approaches it, okay? But I don't want you to get all hung up on that account. That's all we're doing. I call it the layover account. It's kind of like service revenue is on its way to the retained earnings account. And instead of getting a direct flight, it has to lay over in the income summary. And that's really what's occurring there. Same with the expenses. They have to lay over in the income summary before reaching their final destination, the retained earnings. Any questions? There we go. Okay, so let's go back over to our notes and do our final. Oh, well, we'll post that one after we do the final journal entry. The final journal entry is to reset the dividends account so that it will have a zero balance after posting the closing journal entry, just like the other ones. Okay, but dividends, they go on more of a direct route than our revenues and expenses. But that's what we're accomplishing, and that's it. That's what these 4 journal entries are. Resetting revenues to zero, resetting expenses to zero, resetting the income summary to zero, resetting the dividends to zero, and getting all those balances to their final location, which is retained earnings. And you'll see that magic in a second here. So I'm going to go ahead back over. 12/31/2018, CL4. The current balance in my dividends account, there it is a debit of $23.40. But I'd prefer you look at your general ledger to see that balance of $23.40 on the debit side. So how do we reset it to zero? Well, you got to credit the dividends account, $23.40, and debit retained earnings, decrease retained earnings. Direct flight. No accounts along the way to stop in. Remember, dividends decreases retained earnings, right? So that's why we debit it. And net income increases retained earnings. That's why we credit retained earnings. So if we first post journal entry number 3, debiting the income summary account for $7,600, credit that new account we just created, retained earnings, Then debit retained earnings for the fourth journal entry amount, $23.40, and credit the dividends balance of $23.40. Now, dividends are zero balance, revenue zero balance, all of your expenses are a zero balance. That income summary account has a zero. But retained earnings. It has a credit in it of $7,600 and a debit of $23.40, so I'll subtract those. And I'm getting a credit balance of $52.60. Now, through our process so far, we have always worked with a company that was starting brand new. First month of operation, first year of operation. But at the end of that year, after that first year, the company needs to store its net income or net loss, subtract its dividends, into the account they belong. During the year, we collect all the information about those accounts in separate areas: revenues, expenses, dividends. But after the first year, when the company has had some earnings and some dividends, we have to store those effects as one balance in an area: retained earnings. So now our retained earnings account will have a balance because there were earnings already. That first year is done. When we go into the second year, their retained earnings balance starts at $5,260. Of all the earnings the company made in their first year, $7,600, they gave $23.40 of it to the owner, and they've retained $52.60 of it. And then each year after this, we will update that account for that year's earnings less the dividends. So now you will see an account called retained earnings with a balance in it, and it is a stockholders' equity account. Now, how else do we know we're right? We already reported this on our statement of retained earnings. So if we have an account called retained earnings, it better agree to the balance we reported to our decision makers. Okay? So let me go back over to my notes. I just wanted to take a pause here. Any questions on any of that? Woo. Okay, I'm going to come back over to my lecture notes. Well, we've already done this as we've done the journal entries, but the next step, if you hadn't done it already, is post the closing journal entries to the respective T account in the general ledger, and then update the balances. And then the very last step, just like any other time we post to the T accounts and find new balances, we're going to create our final trial balance for the accounting year, and it's called the post-closing trial balance. Post meaning after, so after you've posted all your closing journal entries, here's where your accounts with their balances stand. So it's a trial balance. A trial balance is a list of all the accounts with their balances. So if an account doesn't have a balance, you don't have to write it. It doesn't mean there's no T account. It just means the T account is a zero balance. So I'm going to come back over to my practice here. And I'm going to create my final trial balance, which it's still one long column and two small ones for the numbers. And using my general ledger as it currently stands, excuse me. Sorry about that. Sneezed. But using our trial or our general ledger, we're going to create this post-closing trial balance. So we have Guthrie in company, post-closing trial balance, December 31st, 2018. Now list any assets, liabilities, or stockholders' equity that the company has balances in on this date. Cash, $13,500. Debit. Accounts receivable, I'm using my T accounts, $15,100. Prepaid insurance, $700 debit balance. Office supplies, $500 debit balance. Buildings, $530,000 debit balance. Accumulated depreciation buildings, $261,200 credit. Okay, so there are my assets so far. I have 3 liabilities and they all have balances. Accounts payable, credit balance of $1,710. Salaries payable, credit balance of $1,080. Unearned revenue, credit balance of $1,600. My common stock has a balance of $288,950. Dividends are 0. My service revenue is 0. Each of the expense accounts are 0. Income summary is 0. Oh, but retained earnings has a credit balance of $52.60. So I got to write that in. I'm going to total both sides to make sure debits equal credits, and that's the primary reason for doing this. Oh, whoops. And they equal. And when that happens, we go, woohoo, we're done with the 2018 accounting year. Our general ledger is all up to date, it's all cleaned up, and I'm ready to start my accounting year 2019 from the very beginning, doing all those steps in the process again. And that's what we do year after year after year in a company's accounting system. So I'll give you a second to get that information down. And if you have any questions, just shout out here. I have 1 or 2 things I want to talk about, and then I will let you go. But essentially, we've done 90% of what you're responsible for in Chapter 4. 1 or 2 little things to talk about. And like I said, on Tuesday, I'd like to use a problem and go through chapters 3 and 4 one more time in class, just so you're all on the same page. Will you be reviewing? Yes, that's what I was just saying, Austin. We're going to use a problem in class on Tuesday and go through this whole process again. Cool. So I'm going to go back over right now to my lecture notes here. And I want to finish something I started talking about. Remember up here I said there's 2 major classifications or types, two words we could use to describe accounts. One is temporary, and we've listed the temporary accounts. These accounts must be reset to 0. But the other word is permanent. And permanent doesn't mean the balance never changes. A permanent account doesn't get reset to 0 at the end of the accounting year. Okay, so you just keep going and going and going. You keep updating these balances as you go. You don't reset them to 0 at the end. And those are your assets, liabilities, common stock, and retained earnings. So these accounts not reset to 0, and these are the only accounts that will appear on your post-closing trial balance. So in class, I'll say, give me 1 word to describe all the accounts on your post-closing trial balance. And if you're listening right now, you'll know on Tuesday to say permanent. Okay? So that's what I have for you guys. I just want to bring 1 or 2 things to your attention. We're going to talk more about it. On page 192, there's something called an accounting worksheet. I do not teach this, and I'll show you why on Tuesday. So you're not responsible for it. And at this point, you are not responsible for the performance ratios on page 203, or the appendix. So I don't do anything with ratios yet. We do that near the end of the semester. All right. And like I said, remind me about the project. We'll talk more about that on Tuesday. But for Tuesday, then, we want to make sure we have P429A ready. It's on page 230. Very similar to what we just did with Guthrie Inn, starting with, let me see. You're going to make the income statement for this company, the statement of retained earnings, their balance sheet, classified now, remember categorized. Then you're going to do the closing journal entries, post the journal entries to the T accounts, and prepare the post-closing trial balance. So you could try that on your own, see how you do for Tuesday. Okay, so I appreciate you coming out and completing class in this unconventional way, and bring all your questions with you so that we have everything ironed out for these 2 chapters on Tuesday. And then we could talk more about your test, which I think is going to be an online test, okay, through my accounting lab. Don't freak out. I'll show you what we're going to be doing and give you plenty of time to get it completed, okay? So unless you have anything else, I'm going to stop sharing my screen right now. 341B, yes, I would like 341B done for Monday night, Eric. If you have any questions on it or problems, just drop me an email, okay? You betcha. Are there any other questions before we leave for the day? Okay, well, once again, I appreciate y'all taking the time and meeting me. And then if you have anything, just email me. Stay safe, stay warm, and I'll see you on Tuesday.